things are not probably as bad as a lot of people have made them out to be. I think there's more room, to run certainly in the next few months for equities and for kind of the cyclical side of the equity market in general. And that applies regionally too. I think some of the ex-US markets like Europe still look better because they're more better exposed there and seeing improvement. So I would say focus on the cyclical side of things. And don't be afraid to own a little risk here now.
Welcome to What the Finance. My name is Anthony Fatsies, and I'm the founder of What the Finance. So it seems as if day by day, a new piece of data is released, which changes the narrative and sways the direction that the rest of the year will go. I'm happy to be hosting Sam Burns, founder and chief strategist at Mill Street Research, to talk further about this and his thoughts about what's currently happening in the market. So Sam, thanks for joining the podcast today.
Hi, thanks for having me.
No problem. So I guess, what are your current thoughts on the markets? Nice and simple to start.
Yeah, no, and it's interesting. Having done a few of these interviews and watched the news, I'm actually more bullish now than I have been in probably a year or more. Most of the indicators that I will look at for kind of at least a 1 to 3 month horizon are pretty positive right now, actually. And I think what we're seeing is as a sort of reversal of a lot of the heavy pessimism that got built up all last year. And I think that may have somewhat further to go. So I think if things are sort of less bad than expected, that's a reason for markets to do better, and then they certainly have started off the year on a more positive note.
Yeah, definitely. And there was a really interesting quote that I saw. You sort of, as I said, you're chief strategist in Mill Street Research, and release, I think it's every week you release research. And one of the quotes within one of those was that it said that history suggests that sentiment extremes tend to reverse in the intermediate term as bad news gets priced in, and any signs of good news can provoke rebounds in sentiment and prices. And I guess you could say that's exactly what we've seen. We've seen, even though it's just a little bit of good news, it's caused this massive spike in prices that we've seen over, since the start of the year.
Yeah, exactly. You have to look at everything in the markets in the lens of what's priced in, what's the consensus, and then what's going to change relative to that consensus. So you don't necessarily have to assume that everything's going to be fantastic and to get bullish. If everyone else is already very pessimistic and assuming the worst, then something less bad than expected is definitely enough to provoke a rally, and certainly some of the short covering things that we've seen this year so far, and a lot of that has been driven by a change in perception towards the Fed, and that maybe the economy is not going to be as bad as expected. Maybe we dodge a recession and we just get some slow growth, and same thing is true in Europe. There was, very widespread pessimism towards the European economy all last year, particularly towards the end of the year. And now, again, not great, but maybe not as bad as expected. Maybe the energy, issues will not be as bad as expected, and that's enough. And so I think, having seen everybody get very pessimistic for quite a while after a really rough year last year, we're starting to see that reversal take place now, and there's probably a little more for that to go.
Yeah, it's really interesting. So I guess you mentioned in the intermediate term, as you said, you're quite bullish and you sort of follow these few indicators. Can you maybe talk more about those and why they're sort of suggesting that maybe markets are better than everyone was thinking?
Right. So, part of it is, certainly the Fed. One of the indicators I look at is just looking at, where 2-year U.S. Treasury yields are relative to 3-month bill yields, which generally track the Fed funds rate pretty closely. And, those have been pricing in not just fewer rate hikes, but actually starting to price in rate cuts, within the next, say, 12 to 18 months. And typically that's a good sign when people are expecting rate cuts to happen. That's a bullish sign for equities. And of course, the latest FOMC meeting last week gave the bulls a little more room to run because Fed Chair Powell was focused more on the disinflationary story and didn't push back against the market's rallies recently and the bond yields coming down like he had in a lot of the press conferences last year. So if you think the Fed has gone from a headwind to at least maybe neutral, maybe you get another quarter point hike or two, but after 450 basis points of hikes so far, that's not that big a deal, in context. And if you think that's probably the end of it, and then maybe they bring rates back down late this year, early next, again, that's a pretty good sign. Then you also have things like industrial metals prices looking better, copper and things like that, as China started to reopen. So one of the indicators I looks at industrial metals relative to, say, precious metals, which are more of the kind of the risk off trade, and they've been looking better. So if China's maybe doing a little better now, Europe maybe is looking better than expected. The Fed maybe is going to slow down shortly, and you've got earnings that are not growing much but are sort of stable at least in the U.S. Then that doesn't look too bad. That's not a severely negative scenario. That's just sort of a slow growth and kind of end of the Fed tightening cycle scenario. And that's what was priced in late last year. So now we've seen the market momentum improve. So the measures of risk appetite, looking at the higher beta stocks have been outperforming lately. Overall momentum has been rising, volatility has been falling. Those are all good signs to show that the market is in fact responding to these kind of macro factors and acting better. So we've broken out of some of the the ranges we've been in, and seen better risk appetite across a number of metrics, including credit. So credit spreads have come down. So people are not pushing up credit spreads on high yield or investment grade bonds in anticipation of a recession. So again, that's a kind of a cross asset view of better risk appetite. So all those things kind of tie into the indicators I look at on that kind of 1 to 3 month horizon, and they're all looking much better than they did most of last year.
Yeah, it's really interesting. So yeah, and I think one key thing you mentioned there was credit, and it seems like that's probably one of the most bullish aspects of it. So from my understanding, when reading it, it's the spread between, I guess, company credit and sort of government bonds. Is that correct?
Exactly. Yeah, the premium you have to pay to for people to buy corporate bonds rather than safe treasury debt has been narrowing. It got pretty wide last year and has been narrowing. And that the direction is what's important. It's whether it's going up or going down, and it's been going down, and that's a good sign that that credit investors are not worried about credit quality so much now, and that equity investors then sort of can take that as a sign that corporate profitability is not going to be a major issue potentially this year. So that's a good sign relative again to what people were expecting late last year.
Yeah, definitely. It's crazy to think everyone was so bearish, and now look where we are. So if you look past three months, so maybe sort of 3, 6, 12 months potentially, do you have any insights into, I guess, what the markets could do there, or are there indicators that you're currently watching that can give you an insight into that?
Yeah, I think the overall picture is probably going to over the next say year or two will probably shift back closer to what it was pre-COVID, assuming we don't have any other major global catastrophes that act as shocks. I think the long run trend is back to sort of slow growth and lower interest rates, and sort of pre-COVID kind of conditions for the most part. I think the long-term demographics, technology, policy, all that kind of stuff will tend to sort of drift slowly back towards where it was once we've kind of gotten past a lot of the shocks from COVID and the stimulus that came after COVID, and then Russia and China and all those things that have happened in the last couple 3 years. Those have been big shocks we've had to deal with, and so in the absence of further large shocks like that, I think we'll probably go back to something closer to what we had pre-COVID. Now, the next 12 to 18 months, maybe that means we're in a kind of a broad trading range in equities. Or maybe we make a nominal new high, or we get to the upper end of the range and then pull back, and so you have kind of a slow grind higher, or kind of a big broad trading range for a while, which would be less exciting for equity investors overall, but not the end of the world. But I think if as long as there are no major policy mistakes by either the fiscal policy or monetary policy, and you don't have any other major global shock like COVID, then I think that's kind of the direction you'll be going. I think there's a bit more room for equities to rally and bond yields to come down a bit over the next year or two. But then after that, it'll be kind of the back and forth, choppy grind higher as we get back to kind of slow growth, low inflation, lower interest rates, that kind of condition.
Yeah, so back to, I guess, lower volatility as we saw during that period as well.
Right.
Yeah, that's amazing, because I think a lot of people have been, I don't know if they're hoping or they've been saying that we're sort of going to experience a secular shift of, low interest rates are over. We're going to go into, increased inflation and high interest rates for longer. So you don't see any trends that could, or things that could occur. Yeah.
I mean, it's certainly possible. But I think a lot of the long-term trends that had been pushing inflation lower and interest rates lower are kind of still there. They're just in the background. They've gotten completely overwhelmed by all the the effects of COVID and everything, and Russia and everything else that's happened. So, as long as, like I say, there's no more major disruptions to the global energy supplies, or major global health issues or things like that, then I think those factors that were driving things before, haven't gone away. And so the technology and productivity is still ongoing, and that's a naturally inherently disinflationary force. And so as long as nothing disrupts that in a really major global way, then I think, yeah, you kind of go back to where we were, just because demographics, population growth is still quite low in most of the developed world, and China and Russia, and a lot of places outside of some of the more developing countries. And so I think that's kind of the backdrop you're in. Populations are aging. That increases demand for fixed income, and kind of slows general growth overall. So I think all those things combined will tend to kind of, over the longer run, push you back toward those conditions we saw before, unless there's major policy changes. If fiscal policy becomes much more stimulative over the longer term than it's been for a long time, then that would change things. Basically money printing at the fiscal level. But I don't really see that happening. We got that with COVID as a response to a crisis, but certainly now in the US, with the Congress being split now, we're not going to get any major new fiscal initiatives probably for a while. I would be surprised if there was anything of a major magnitude in Europe. China will probably try, but they're struggling against a big real estate bubble and demographic issues as well. So my guess is that, absent again a big supply shock, the demand side is not going to be there over the longer terms, the next 5 years, to produce the kind of long-term secular inflation that some people have talked about. I've certainly seen some of the same things that probably you have about that sort of super cycle trend in inflation commodities, something like the 70s, 60s and 70s. And I don't really see that. I see this as more of the kind of like after World War II, after the Korean War, you had a big burst of kind of inflation as things got back to normal after a big war and a big disruption after a couple of years, and then things kind of went back to normal, kind of lower inflation, kind of conditions. And I think that's probably closer to what we'll have over the next few years.
Yeah, and then a Japanification basically of Western economies.
Right. Something closer to that. Exactly.
Yeah, definitely. So I guess you've sort of been implying it, but would you say that, I guess, in the short term, we've probably had a bottom in the US equity markets, at least, unless there's that massive shock?
Mark to bottom, you said? Yeah. I think probably the lows from late last year will hold. We could have another leg down at some point. If it looks like the Fed may have to be a little more hawkish than expected, or earnings turn out weaker than expected. But I think we'll probably that low last year will be the low for a while, and then the peak from January last year will probably be the cap for a little while. So I think we're going to be in this big wide trading range, kind of moving back and forth and kind of grinding higher for a little while longer, as things kind of investors adapt to kind of back to closer to what we thought was normal pre-COVID. That process may take a while. Certainly things like the labor market in the US haven't fully recovered and adapted to get back to where they were, whereas supply chains for goods and things have. And so as these things, and the data has been very volatile and hard to figure out, all the economic data has been very kind of skewed and hasn't behaved like a typical cycle. So that's why the risk of policy mistakes is arguably higher now. If you misinterpret the data and look at something incorrectly, you might overcorrect in terms of policy. I think we might avoid that. There's still a risk of that to some degree, but I think that the Fed will at some point realize that 5% raise probably won't be necessary by the time we get to mid-year, and the reported inflation rates come down closer to kind of 2.5%. Which is where they've been the last 6 months. So I think all that kind of stuff will continue to shift over the next year or so, but it'll be a process. It won't be a straight line up or down. But I think the lows from last year will hold.
Yeah, really interesting. So I guess if we look at since the 80s, it's been quite a good trade, and I'm pretty sure I've got this the right way around to long bonds, because normally the yields go down and the price goes up. So do you think that's sort of going to be another potential good trade in, I guess, the coming years?
Yeah, I would be surprised if you saw long-term bond yields go much above where they were, late last year. And because I don't think the Fed policy is going to push it that far. And we've already seen the inverted yield curve telling the market telling the Fed that the market thinks rates are already too high, and they're probably going to have to come down. And even the Fed's long-term forecast for policy rates is that they published is about 2.5%. So that's where they think we should wind up over the next, say, 3 to 5 years. Steady state is somewhere around there. So if you take that roughly as kind of the right rough level, then yeah, you would see bond yields hover here or drift lower rather than go higher. So that would means that you could own bonds and do okay, rather than expecting another big leg up in yields, which would then raise the risk of bonds. So yeah, I think the demand for fixed income is still there. I think policy won't be the driver to push rates much above where they were, and most likely they'll probably come down over the next, say, year or two as we get closer to kind of normal inflation rates and normal growth rates.
Yeah, interesting. So you mentioned earnings. I think at the start of the interview, and you're saying sort of they weren't as bad as people thought. So I guess if we look at a few examples just off the top of my head, Apple sort of just missed, and I guess Amazon missed as well. So do you think that it was the fact that they didn't miss? It wasn't a catastrophe, basically. They missed, but it wasn't that bad. That why we haven't seen market reaction.
Right, exactly. Yeah, we had what looked like bad news from some of these big mega cap companies, and markets, kind of got over it. And I think to some degree, analysts have been lowering estimates for a lot of those names you mentioned, Apple and Amazon and so forth, for months, and they may still continue to do so. But even the analyst behavior that I track pretty closely has gotten pretty negative. They've been cutting estimates for a while. They've been cutting estimates very broadly across a lot of different kinds of stocks, but particularly in the big tech and kind of tech related names that were the leaders previously, for a long time, and certainly just immediately post COVID. A lot of those companies, overhired. They got a lot of benefit from the work from home trend and everything else right after COVID, and now they're having to kind of correct and get back to something more kind of a normal trend for themselves. And so other areas of the economy are maybe picking it up a little bit. Maybe it would be financials or industrials. Some of the consumer discretionary areas are looking better in my work. So I think there's been a rotation rather than a full scale meltdown in earnings overall. And the profit margins for U.S. companies were very high, certainly for the large caps, in 21 and 22, and probably were not sustainably high. So they're coming. Really, the factor that's coming down is the profit margins. Top line revenue is still holding up okay in aggregate. So I think that tells you that again, it's a part of a return to what would have been normal pre-COVID, both in terms of the economic data, but also in terms of profit margins and earnings growth. So that's a process again to be worked through, but it doesn't mean it's the end of the world. And investors are now starting to look ahead and see, okay, the numbers have been brought down quite a bit. Some of these companies are already starting to lay people off and cut costs. And I think that tells you that they're responding and will bring things back to more kind of normal situations where you can get some bit of growth over the next few years.
Yeah, interesting. So yeah, I know that if I'm not mistaken, you analyze, I think it's analyst estimates or analyst revisions and what they're thinking. So yeah, as you said, it did go negative. So do you sort of see a similar thing in the markets where it's sort of when it's peak negative is almost when the time when you see that reversals? And I guess maybe what are these analysts thinking at the moment generally?
That's right. That's right. Yeah. One of the things I do look at is what analysts are doing with their earnings estimates. Looking at their 12-month forward earnings estimates in aggregate, then across sectors and industries, and then at the level of individual stocks. And yeah, we've seen very broad-based cuts in estimates. Pretty much every sector in the U.S. has been seeing some level of estimate cuts on average, but with varying degrees. And that tells you that analysts are expecting the Fed tightening and the reduced fiscal stimulus and the slowdowns in the rest of the world to affect U.S. earnings. But once they've gotten to a sufficiently negative kind of posture for a while, either things have to get then still worse from there, or things start to mean revert. And that kind of mean reversion in sentiment is true for both investor behavior that you see directly in the markets, but also for analysts. And so if you don't think we're going to be in a 2008 or 2020 style, severe recessionary kind of crisis, then earnings estimate revisions have gotten about as negative as they tend to get outside of major crises. And so the odds are that if we avoid a major crisis, then they're probably going to, start to kind of get less negative. So not to say that earnings are going to suddenly become spectacular, just that they won't be falling at the same rate. And again, that kind of momentum or the second derivative or those inflection points in the direction of behavior is what really tends to drive markets and be the kind of leading indicator. And so we're starting to see that already a little bit in response to the Q4 earnings. A lot of people were really expecting bad things, and maybe they're just not quite so bad. And maybe if the Fed stops hiking and the job market holds up better than expected, well, okay, that's not too bad, and earnings might be okay. Maybe they don't grow this year, but they're not falling off a cliff. And so I think a lot of people are kind of in that fall off a cliff camp. Certainly some of my fellow strategists have been, and so I think maybe if we avoid that, that's enough to kind of boost the market a little bit and to bring analysts back from that kind of very negative posture.
Yeah, super interesting. So in terms of, I guess, as you said, it's sort of being, I guess the indicators have been growing slowly from the start of the year, if I'm not mistaken, going positive, and now they're quite positive. So is that the same trend, say, when it goes negative, or is it faster when it goes negative, or how does that work?
Yeah, I think they tend to kind of deteriorate faster than they improve. But again, it's trying to look for those inflection points, and when things have been really good and they're getting less good, that's usually kind of an early warning sign, versus when things have been very bad and they're getting less bad. And so you look at that, again, in equities directly in the major indices and things like that, and volatility. And you also look at, cross assets and fixed income and commodities to see kind of what's going on there. And, the commodity prices kind of peaked in June, July last year. They've been coming down, but now we start to see energy prices, weakening, but, some of those metals prices picking up, which is a good configuration. And so if we saw the reverse happening, we saw energy prices going up, and maybe precious metals prices going up, while the copper and the industrial metals that are more growth sensitive going down, that would be a warning sign. So and these things all are naturally cyclical, which is why I tend to look at things on a rolling 1 to 3, maybe 6 month basis, and trying to make too many big long-term forecasts, because you have to adapt to what you see, and things can change quickly. And so certainly 2020 was an example of an almost unprecedented V-shaped movement in equity markets. They plunged, everything fell apart, and then the Fed and the federal government showed up and boosted everything with lots of stimulus, and so you had a dramatic reversal. And then you had the vaccines come out and provoked another big move. But those are sort of exogenous external events that had a major impact, but that you couldn't really necessarily forecast based on traditional economic indicators and things like that. Absent those kind of events, these indicators are pretty good about capturing those inflection points. And so, yeah, right now we're seeing them moving in the right direction. But starting in early 2022, they were all starting to kind of roll over and moving in the wrong direction. And I think that's the key, is to look at them, a lot of different indicators. No single indicator is ever going to tell you the full story. And so if you look at the major macro indicators, the earnings estimates are more bottom-up based, kind of individual company based, and put them all together, you get a pretty good picture. And right now it's that kind of coming out of a trough sign that's more favorable.
Yeah. So as you said, top down, bottom up combination, and then that might give you a better insights on what's happening in the market.
Right, exactly. Yeah, you got to merge those two things, because sometimes the macro data can throw you off, sometimes the bottom-up data can throw you off, but the two together will usually give you a picture. And as long as you kind of know how the cycles tend to work, and when to look for inflection points, then you can get a lot of information there.
Yeah, that's really interesting. So Sam, thanks so much for your time today. I really appreciate it. So I guess my last question is, what is one message you'd like people to take away from our conversation?
Yeah, I think the main message from the indicators I look at is that the things are not probably as bad as a lot of people have made them out to be. I think there's more room to run, certainly in the next few months, for equities. and for kind of the cyclical side of the equity market in general. And that applies regionally too. I think some of the ex-US markets like Europe still look better because they're more better exposed there and seeing improvement. So I would say focus on the cyclical side of things. And don't be afraid to own a little risk here now, but be careful for policy mistakes going down the line.
Yeah, that's great. So Sam, thanks again for your time. So we've mentioned your research company. Is there anywhere else that people can find you, or is that the best place?
Yeah, certainly millstreetresearch.com is a good place to see everything. There's examples of the research, and there's a weekly report that you can subscribe to that I have on there. Also on Twitter, and post pretty regularly there on that Mill Street Research. You can look it up there. So there's a lot of places to kind of get a feel for what I do. And you can always reach out. It's a contact form if you want to ask questions about the work.
Perfect. I'll put that all in the description below. So Sam, thanks again.
My pleasure.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.